WFSU-FM now presents a delayed broadcast of the August 19th, 2015 luncheon meeting of the Economic Club of Florida. This program was recorded at the Florida State University Alumni Center in Tallahassee.
Welcome to the 476th in our series of distinguished speaker programs. I'm Dave Micah, your club president. The Dow at the noon hour is 17,304, down 207. The price of crude is trading at 42.62. A couple of notes today, upcoming programs. We're still working on our schedule for September program. You'll be notified of that soon. But we can confirm that John Sawyer, Executive Director of the Pulitzer Center for Crisis Reporting, will be here on Friday, October 23rd. We'd also like to announce that the club is waiving our initiation fees for new members ages 40 and younger who joined through December of this year and pay for a full year in advance. We'll be counting on our current members to let us know whether sponsored members are 40 or younger, so don't cheat. We're also taking nominations for the 2015 Stan Tate Memorial Award. The awards is to recognize a current or former club member in good standing who displays the character, dedication, integrity, and passion for service epitomized by founding member Stan Tate. The nomination form is available at www.economicclub.com or by calling the office. We need your nominations by September 15th, either by mail, regular mail, or email. Have some new members in attendance. I'll be introducing Marissa Langston in a moment. But if Emery Mayfield, Jessica Lowe Minor, or Fraser Smith here, would you raise your hand or stand up so we can recognize you? Hey, Fraser. Here we are. Great. Welcome. Also, I'd like to recognize our Florida A&M Business School student members at this table here. If y'all would raise your hand and let us recognize you. Welcome. We're glad you're with us. Now I'd like to introduce our head table. If you'd please hold your applause till I've introduced the entire table. Beginning on my far left or your right. First is Kim Dixon. Kim Dixon is the Vice President for AMB Investment Advisors. She received her Bachelor's of Arts degree at Mercer University and completed her graduate studies in art history at Georgia State. She's our immediate past chair and on the board of Tallahassee Community College Foundation and also on the board of the Tallahassee Symphony. She was named as one of this year as one of the Tallahassee Democrats' 25 Women You Need to Know. Lindsey Piegza. We're going to get it right today. Piegza is our guest, and I'll formally introduce her in just a minute. On my right and your left, Katie Wojciechowski is a Senior Investment Officer of Fixed Income for the Florida State Board of Administration. When she joined in 2009 as Senior Portfolio Manager, Katie had over 25 years experience in asset management, serving 12 years with ING Investment Management. She serves on several board committees as well as serving as our chair of the Division of Treasury Investment Committee. Katie. Kathy Bell. Kathy is a good friend and graduated from the Florida State University with a BS and a Master's in Education. She operates Colony Bell Engineering, in which she and her husband, John, have owned for 20 years. She's a graduate and past board chair of Leadership Tallahassee, a current board member of that group, past board chair and alumni of the Southern Scholarship Foundation, as the incoming chair of the Greater Tallahassee Chamber of Commerce Board of Directors. And finally, Marissa Langston. Marissa is the Director of Alumni and Student Engagement at the Florida State University College of Business. She's responsible for the strategic planning, program development, fiscal and personnel management of all alumni engagement, the annual fund, and other activities of the college. Marissa received her bachelor's degree in finance and real estate from the FSU College of Business, as well as her master's degree in marketing. Ladies and gentlemen, I present the head table. Now I'd like to introduce our guest speaker. Lindsey Piegza is the chief economist for Stifel, specializing in research and analysis of economic trends and activity, world economies, financial markets, and fiscal policies. She joined the company in 2015 amidst the merger with Stern AG, where she served as chief economist there. Prior to that, she served as the economist for FTN Financial and 8 years in New York City for 8 years. In addition to her work experience, Lindsey published several academic papers in journals such as the Harvard Business Review, as well as textbooks published by Northwestern University's Kellogg Graduate School of Management. She's often quoted in business press, is a regular guest on CNBC and Fox Business, as well as other national radio and other business news outlets. In fact, she's leaving us to go do a national broadcast right after her talk this afternoon. She's a graduate of Northwestern University, having earned her BA in political science and a BA in economics with honors and distinction. And she's a PhD candidate in economics at the City University in New York. She's based in the downtown office, the downtown Chicago office of her company, and I hope that you would please join me with a warm Economic Club of Florida welcome for Lindsey.
Well, good afternoon, everyone, and let me start by thanking you for joining us this afternoon and giving me this opportunity to speak with you as I present the economic outlook, looking beyond the first half of the year. Now, if you remember, the first half of the year was a little bit volatile. We had a very slow start out of the gate. We did see a pickup in momentum in the second quarter, but now as we look out to the second half of the year, the question is, will we be able to maintain what we saw in the second quarter in terms of growth? Will we see additional momentum in the economy? Or will it slide back to that general malaise that we saw across the first 3 months of the year? Now, really, when we talk about the economy, I think there are 3 key questions that we want to address. One, what will monetary policy look like in 2015 and 2016 and beyond? Also, what is driving the Fed to make that decision as we still sit here waiting for liftoff, that first rate increase? We know the Fed is watching the labor market. We know the Fed is watching inflation. But now the Fed is also watching international developments. And of course, when we look at the consumer, when we look at inflation, we look at the labor market, really we want to know, what does this mean for overall growth in the U.S. economy? So we're going to address all 3 of those questions this afternoon. But let's start with monetary policy. This is really the most exciting. And right now, as we look out to that September FOMC meeting, I know we're all on the edge of our chairs waiting to see what Chair Yellen decides. I heard laughter there, no? All right, I'm waiting on the edge of my seat. But right now, looking out to that September meeting, still the vast majority of economists are anticipating a rate increase next month. 4 out of 5 private economists say, yes, we're going to see interest rates rise for the first time since 2006. 4 out of 5 private economists continue to estimate September as the appropriate timeline for liftoff. But now, let's take a step back and think, if the Fed, in fact, was gearing up to raise rates just 4 weeks from now, the July meeting, the last meeting before the upcoming September meeting, would have been the perfect opportunity to signal to the marketplace that the Fed was, in fact, gearing up to raise rates. The July statement would have been the perfect opportunity to signal to the marketplace, we're increasingly confident in the composition of economic growth. We're increasingly confident in the current growth momentum that we're seeing. We're increasingly confident that the economy is going to pick up sizable momentum in the latter half of the year. But instead, what we saw is the Fed said, well, the economy is moderately expanding. Good, but not great. Not the type of momentous improvement in language, again, that you would expect from a Fed gearing up to raise rates for the first time since 2006. So let's actually look specifically at what the Fed said about the economy. Well, what about household spending? We're a consumer-based economy. We need the consumer happy and healthy out in the marketplace spending. In June, the Fed said spending has been moderate, tepid. They maintained the exact same language in July. As far as business investment and exports, the Fed said back in June, that's actually slowing. They maintained that same slow language again in July. What about inflation? Since December of 2012, every Fed communication has said inflation remains sluggishly low, below the Fed's longer-term target of 2%. They said that again in June and maintained that exact same language in the July statement. So again, overall for the economy, the Fed continues to say, well, we're seeing moderate expansion, not great, still positive, but not the robust expansion that you would expect 6 years into the recovery. Now you're saying, wait a minute, Lindsey, it wasn't all the same, and that's true. We did see modest improvement when the Fed categorized the labor market conditions. In June, they said job gains picked up. In July, they said job gains improved modestly. We saw job gains with solid job gains. Forgot the exact wording there. In housing, they said it improved somewhat. By July, they said it saw further improvement. So we did take some steps in the right direction, but overall, the Fed maintains a very modest assessment of the economy. Now, I want to put that in perspective to what we've seen from the Fed over the past several months. And you can see that expanding moderately is, in fact, an improvement from that characterization of slow back in April. But we still haven't clawed back to strong, as the Fed said the economy was growing back at the start of the year. So we saw a lateral move from that June characterization as the Fed continues to say the economy is on moderate footing. Again, modest but positive, but the problem here is that with that type of wording, the Fed continues to recognize the underperformance of the economy. And remember, that underperformance has kept the Fed on the sideline at near zero interest rates for the past several years. How many of us thought we'd be sitting here in 2015 waiting for the first rate increase? The Fed's been telling us rates are going up next year every year since 2009. We thought rates were going up in 2010. Remember the market chasing rates in 2011, 2012, 2013. We're still sitting here in the second half of 2015, and we do suspect that the underperformance that the Fed continued to recognize in that July statement will keep the Fed on the sideline much longer than the market expects. As I mentioned at the start of the section, the majority of economists, 4 out of 5, are anticipating the rate to go up in September. I suppose I fill that fifth vacancy, as we do expect the Fed to stay on the sideline through that September meeting, even through the December meeting, and into 2016. And we've maintained that 2016 outlook for the past several years, since 2013. Now, I know 2016 seems like a very far way off, and in fact, it wasn't more than just a couple weeks ago that Chairman Yellen gave her semi-annual monetary policy testimony, also known as the Humphrey-Hawkins Testimony. And in that testimony, she said 2015 may still be appropriate for the first rate increase. If, and here's the big caveat, she said if the economy continues to improve, if the labor market shows at least some further improvement, and if inflation begins to reverse course back towards 2%. So just as the Fed has said for the past several years, they're ready and willing to raise rates if the economy gains legs and is on firm enough footing to justify liftoff. So she said, let me emphasize again that these projections, that 2015 projection, is based on the anticipated path of the economy, not statements of intent to raise rates at any particular time. So in good Fed speak, she's hedging that bet a little bit. Now, one of the problems is that the Fed does not have a great track record of forecasting reality. In fact, if you look at the chart up here, you can see that the yellow line is what the Fed tells us is going to happen. The bars are what actually does happen. And the Fed consistently overestimates or overforecasts growth in this country by 100 to 300 basis points. That's 1 to 3%. So in fact, if the Fed tells us, don't worry, the economy's probably growing at a 3% pace, we probably come in around 1 and 2. If the Fed says, don't worry, we're probably going to come in right around 1 to 2%, we may already be in recession. Now, already, Fed officials themselves, aside from the chairman, are beginning to question the Fed's own internal forecast. We hear from several different Fed officials. If you read the Wall Street Journal this morning, Minneapolis Fed president saying, if you raise rates now, that will be detrimental to the economy. We have to wait much longer, well into 2016 or beyond. We've heard from Evans out of Chicago saying most likely liftoff will be a 2016 event. On the other hand, we still have some of the most hawkish members. We have Williams, Dudley saying, well, any meeting is on the table or off the table. It all depends on the incoming data. And again, the data does not yet suggest the economy is on strong enough footing to justify the first rate increase since 2006. So again, Fed officials themselves questioning that internal forecast, or better said, questioning the economy's ability to reach that now twice lowered bar of expectations. And in fact, with such a slow start out of the gate, with GDP up just 0.6% in the first quarter, 2.3% in the second quarter, that gives us an average of just 1.5% per quarter in the first 6 months of the year. 1.5%. So now, in order to meet the Fed's twice lowered bar of expectations, so to even meet that lowered front now for growth expectations, the economy will have to grow at least a 3% pace on the back end of the year in the latter 6 months. Unfortunately, we think that is going to be impossible. We still think the economy is going to grow at a positive pace, but at much less than 3%. We're looking at around 2% GDP. So again, coupled with a 1.5% average in the first part of the year, that gives us an average annual rate of 1.8%. Well below the Fed's outlook for growth. So again, the Fed overshooting what is likely to come into reality. Now, one more thing I want to point out about the Fed before we move on to the data is that we've almost become obsessed with pinpointing the exact timeline for liftoff. Will it be the September meeting? Will it be the December meeting? Or as I suggest, 2016? But really, the more important question is, what will the pathway of rate increases look like even after that initial rate increase? And what we do know is that rate increases after the first liftoff will not look like this chart behind me. We've heard from Fed official after Fed official that this time around, the tightening cycle will not be like what we saw in 2004 when the Fed was wed to the idea that we had to raise 25 basis points at every meeting. We went from 1% to 5.25% in under 2 years. This time around, we could see a 25 basis point increase, pause, another 25 basis points. We may only see 50 basis points of an increase on an annual basis. That means, assuming again that 50 basis point increase, getting to a longer term target of 3% or above on the Fed funds rate, that's not going to be a 2016 event. That's not going to be a 2017 event, 2018, 2019. We're talking about getting to 3% out in 2020. The Fed chairman telling us it may take years to get back to a new normal on the Fed funds rate. So again, every night when you're debating when the Fed is going to lift off, think about the more important question, and that really is the eventual pathway for rate increases. And I think that's a good segue now to the next question, which is, what is the Fed watching? Now, we know the Fed has a dual mandate: stable prices, full employment. And the Fed will not sway from that mandate because the market is growing impatient. The Fed will not sway from that mandate because of political pressure, one way or the other. Nor will the Fed sway from that mandate and raise 25 basis points just to see what happens, as some media heads have suggested. So when it comes to the labor market, really the discussion has centered around the civilian unemployment rate versus peripheral indicators. Now, for the hawks on the Fed, the hawks meaning the ones that want to raise rates sooner rather than later, they're looking at 58 consecutive months of positive payroll growth. They're saying the labor market consistently adds jobs, and we've seen enough job creation that we've been able to reach and surpass the previous peak in total outstanding employment, with 11 million jobs created since the end of the recession, 3 million alone just last year. And in fact, the growth in the labor market, the hawks say, has been so great that we've been able to drive down the unemployment to 5.3%. 5.3%, well within the range of what the chairman has told us is full employment, 5 to 5.8%. And we've been there since October of 2014. So the hawks say this isn't a one-off report. We've been at full employment for quite some time now. So that's the hawkish argument. And at the upcoming September meeting, the hawks are going to point to this chart and say, guys, we need to start raising rates. We're at full employment. But as Chair Yellen has said, labor market conditions have certainly improved. But further improvement is still needed to convince policymakers that the labor market is in fact strong enough to withstand a rise in rates. Because looking at the civilian unemployment rate doesn't tell the whole story. Looking at the 5.3% unemployment rate doesn't take into account a multi-decade low in the participation rate. That 5.3% pace doesn't take into account the fact that millions of Americans have looked out to the labor market and said, right now, conditions are so bad, I'm not going to bother looking for a job. And how do we calculate unemployment in this country? You have to be actively seeking a job to be counted. So I always say it's very easy to get the unemployment rate down to 0 if nobody's looking for work. Come on, that was funny. That's my best one. Now also that 5.3% unemployment rate, that doesn't take into account the millions of Americans that are working part-time that would rather work full-time but can't find full-time employment. It also doesn't take into account the millions of Americans working temporary jobs that would rather have full-time employment but can only find temporary work. So all of a sudden, if we add in all those part-time for economic reason workers, so the ones that are temporary or part-time that would rather work full-time, if we add in all those marginally attached workers, all those discouraged workers, well, now you're not talking about a 5.3% unemployment rate, you're talking about 10.4% unemployment. That paints a very different picture, a much more dire picture of the U.S. labor market. And so now it makes sense why Chair Yellen and others have said, wait a minute, guys, we can't just focus on that 5.3% unemployment rate. We have to take a step back and look at the secondary and tertiary indicators to really understand what's happening in the U.S. labor market. Also, we talked about 58 consecutive months of positive monthly gains in terms of employment, but yet that's remained insufficient to absorb all of the slack in the labor market and put upward pressure on wages. Average hourly earnings have been bouncing around 2% since the end of the recession. At this point, we should be talking about 3, 4, 5% wage inflation. But the problem is the momentum in hiring is still lackluster. Now again, 58 consecutive months of positive job creation, but at what pace? At the end of last year, we were averaging 324,000 jobs on a monthly basis. That's now slowed to 225,000. And remember, we need on average 200 to 250,000 every month just to cover population change, just to cover demographic growth. Think of all the immigration, the first-time entrants, college graduates coming out of the University of Florida looking for their job the first time. We need 200 to 250,000 just to cover that demographic growth. We're right now just sitting at 225,000. So again, positive job creation, glass half full, glass half empty, the momentum remains insufficient to translate into upward pressure on wages. Now I know you're saying that's the labor picture. What about inflation, Lindsey? And that's the next part that the Fed is watching. Remember, dual mandate, full employment stable prices. Now, as I mentioned early on, every communication from Fed officials since December of 2012 has acknowledged the fact that inflation continues to run below the Fed's longer-term target of 2%. And Fed officials have acknowledged that, yes, some of that price pressure, that downward price pressure, has stemmed from energy prices, but some has stemmed from outside of the energy sector. Now, certainly, looking here at crude oil prices, you can see that precipitous decline certainly translating into downward pressure on overall prices. But even if we exclude food and energy, we're still seeing that declining trend since 2011. But now, despite the fact that we have seen that declining trend since 2011, so for the past 5 years, the Fed consistently forecasts 2% inflation. So again, another sign of maybe how poor the Fed is at forecasting reality. Again, that yellow line being the Fed's consistent forecast, and the blue bars being reality as inflation has continued to slow and move further away from the Fed's longer-term target. In fact, as the Fed sits on the sideline waiting for inflation to reverse course, looking here, the question is really not when inflation will reverse course back to 2%, but what inflation? We're looking at the PPI down 0.8% year over year, the CPI up just 0.1%. Even the PCE, the Fed's preferred measure of inflation, you can see since 2011, both headline and core, which excludes food and energy, just to give us a less volatile indicator of price pressures, both continuing to decline from that peak back in 2011. The PCE up just a few tenths of a percent. The headline down from that 1.4% as of last month at 1.3%. So still declining from that 2% threshold that the Fed consistently tells the market, don't worry, we'll be there soon. Now the Fed, aside from the labor market, aside from inflation, back at the start of the year, the Fed added international developments to the list of policy considerations when determining the appropriate timeline for policy firming. Now, under that umbrella, it includes everything from central bank policy around the world. It includes a rapidly rising dollar. It includes declining U.S. exports. It includes tensions between Russia and Ukraine. It includes a slowing Chinese economy. It also includes threats from turmoil abroad in Europe via a Grexit, or a Greek exit from the Eurozone. Now, right now, the market's attention seems to have been diverted back to fundamentals here in the U.S. as Greece appears to be gearing up for their third round bailout. But it's a little baffling that the market seems so calm with this infusion of cash, because this third round bailout does nothing to ensure that Greece won't return to the funding trough again and again and again. It does nothing to address the underlying structural issues of the Greek economy. It certainly doesn't address the fact that the Greek economy is facing over 25% unemployment. It doesn't address the fact that Greece is still facing very sluggish growth with mounting debt to GDP ratio pushing up near 200%. Now, there's no austerity in the world that can bring that debt to GDP ratio back down in line with EU standards without sending that economy into deep recession for years, maybe decades. And so when we look at Greece, the end game for that struggling economy in our mind is the exact same as it has been since negotiations began back in 2010, late 2010. And that is for Greece to eventually leave the Eurozone. Now, for the Greek people, the end game is the same, a decline in the standard of living. But from a political standpoint, when you have 61% of the population voting no to the very austerity measures that you're trying to push through and implement, from a political standpoint, it is much easier to sell inflation than it is austerity. Now, the Fed's concern about international developments has actually excelled into concerns over contagion from international developments or international turmoil. That including volatility in international equity markets. As we're looking here at the Shanghai Stock Exchange Composite Index, we have seen Chinese equities fall, that nice 30% day drop, of which only about 2 to 3% has since been recovered. One of the largest economies showing the slowest growth in years since the great financial crisis, reported at 7%, but our estimates indicate that that is well overshooting, and it's more likely in the range of 4.5% to 5% GDP. Amid a collapsing housing market, prices down over 6% in China. I think we all remember how an economy responds to a collapsing housing market. And of course, the inability to create and sustain a middle-class consumer society. And what we see then is that translates into one of the largest consumers of raw materials, commodities in general, putting downward pressure, not just on energy, but look at aluminum, copper, steel. These are down 30, 40, 50% in some cases from their 2011 peaks. And what that translates into then is further downward pressure on import prices. Import prices were down 2.5% at the end of last year. Import prices were down 5% in the first quarter of this year. They are now down over 10% as of the latest July report. That translates into an even more benign inflationary environment here at home as we're importing deflationary prices from the global marketplace. So again, reinforcing the Dove's argument that the Fed need be patient and wait on the sideline for longer than expected. And of course, on a relative basis, as the U.S. continues to grow legs, still in positive territory, but on a relative basis, looking out to the sluggish growth of our European counterparts, of a struggling Chinese economy, we appear to be, as I like to say, the prettiest girl in the ugly girl contest. And so that continues to, so you laugh at that one. So that continues to incite capital flows into the U.S., putting further upward pressure on the U.S. dollar. And you can see here that tremendous run-up that we've seen, up nearly 15% in just the last 12 months. Now, long-term, yes. Long-term, we want a strong U.S. dollar. We want a sustainable, dependable greenback. But in the short term, as the U.S. economy is still struggling to gain momentum beyond this 2% trend, well, a rapidly rising dollar does what to U.S.-made goods? Makes them more expensive, relatively unattractive then to international buyers, and that puts downward pressure then on manufacturing and exports, which are the two key components of the economy that were providing support if we look back to 2014, 2013. So instead, we're shipping revenue and business overseas rather than keeping that in the domestic economy, helping us to propel growth. So against that backdrop, we talked about the labor market, we talked about inflation, we talked about what this means for Fed policy. What does this mean for consumers? We are a consumer-based economy, and as I mentioned early on, if the consumer isn't happy and healthy out in the marketplace spending, we can't expect much for momentum in the second half of the year or beyond into 2016. So let's take a look at what the consumer's doing. Well, after a general malaise across the first 3 months of the year, you can see that 3 consecutive months of negative retail spending, we have seen a bit of a bounce back, but really an undiscernible trend as 1 month is then countered by flat, and the rebound then is even slower than the month before. So even the rebound months that you see there, we're losing traction on a monthly basis. And that continues to put downward pressure on the annual pace of spending. Still positive, glass half full, but glass half empty, we're losing that momentum from a 5% annual spending pace down to about 2%. Now, again, still positive, but what's so concerning about looking at that declining trend is that it comes against the backdrop of this slide here, lower gas prices. Who doesn't love paying less for gas, saving money? And of course, all of that savings over the past year has translated into an average. Now, this is assuming a one-car family, 20-gallon tank filling up 4 times a month, so you can adjust that if it's a multi-car family scenario. But if we do assume one car, 20-gallon vehicle, 4 fill-ups a month, the average American over the past 12 months has saved nearly $1,000, $896.48. Now, I'm not going to stand up here and argue that that's life-changing money, but $900, $1,000, that is a significant amount of additional discretionary spending to use out in the marketplace. And what makes American consumers so great is that we have this multiplier effect. We feel wealthier because we saved nearly $1,000, so we're actually going to spend $2,000 out in the marketplace, $3,000. So the question is, if we have all that additional discretionary spending capabilities, why haven't we seen retail sales increase? Why haven't I had to adjust my chart and increase the axes? Well, part of the question is rising household costs elsewhere, particularly healthcare insurance premiums. Now, according to the National Online Private Health Insurance Exchange, health insurance premiums have increased 40 to 55% since 2013. That translates into an additional expenditure for the average American family up to $3,000. Let's add in one more variable to the equation: lower wage jobs. The jobs we lost during the Great Recession were high-paying construction jobs, high-paying engineering jobs, high-paying business services jobs. We replaced them with lower-paying admin jobs, lower-paying health and education jobs, arguably a net benefit for the economy, but staying with it from an income standpoint, lower-paying temporary jobs. So the jobs that we lost versus the jobs that we created on a weighted income basis pay 22% less. So you saved $1,000 at the pump, you're spending $3,000 more on health insurance, and you're making 22% less. Now it makes sense why retail sales haven't skyrocketed. Now, on the other hand, what makes economics so interesting is that the way we calculate GDP is not on an annual basis, it's on a quarter-to-quarter basis. So when we look at the general malaise of spending in the first quarter, second quarter, well, even a modest increase, that looked pretty good. And in fact, that modest step up from the negative spending in the first quarter to the modest pace in the second quarter was the primary driver of growth in Q2. In fact, it accounted for 2% of the 2.3%. So consumer spending was really the only support that we saw in the second quarter. Now you're saying, well, that's a good thing, right? We're a consumer-based economy. I look at that a little more skeptically. I'm concerned that without support to the consumer spending is going to decline even further in the third and fourth quarter. And that brings us to investment. Because in order for the consumer to continue to spend, what do we need? We need jobs. We need business development. We need income growth. Because without income growth, we're not going to be able to maintain even that 2% spending pace that we've seen in the second quarter. Now, unfortunately, business investment remains the missing piece from this recovery. We've seen 3 consecutive quarters of very minimal growth, with the latest report showing an outright decline, down 0.6% of business investment. And in fact, this is a long-standing trend, looking at durable goods orders excluding aircraft and defense. Now, I know that sounds like a little confusing of an index, but essentially this is a proxy that we use for business spending going into the GDP calculation. And this gives us a monthly calculation rather than waiting for it on a quarterly basis. And what you can see is that since the mid-part of 2014, we've seen 7 consecutive months of decline. Again, with business investment, according to this index, down near 7% on an annual basis. Businesses are awash in cash. We have very healthy corporate balance sheets, but businesses are hesitant to invest in equipment, software, and high-wage full-time employees. I've been around the country talking to businesses big and small, and we say, wait a minute, why aren't you investing? Why aren't you growing? It's 0 interest rates out there. You're supposed to be expanding, taking on loans, developing, hiring, drawing down the pool of available labor, and starting to put upward pressure on wages. Regulation, tax uncertainty, healthcare costs. Those are the 3 themes that we continue to hear as barriers and burdens to further business development. Now, the final component of the economy that I think we need to touch on is housing. Now, housing is showing some signs of improvement, particularly when we look at existing home sales. So these are previously owned homes that are coming back on the market and someone else is purchasing them. And you can see that after that taper tantrum, let me see if I can get a... Nope. Well, you see that little peak in 2013. That was the taper tantrum. Ben Bernanke came out and said the word taper, and the market thought rates are going to the moon. If I'm thinking about buying a house within the next 6 months, I need to jump into the marketplace, lock in my low rate, and make that purchase. Well, of course, rates didn't go up, and we saw home sales plummet. And since then, they've slowly clawed back, and we finally recaptured that peak in 2013. So we are seeing improvement, particularly in the existing home sale market. Also on the supply side, we continue to see housing starts move further away from that trough in 2009. But here too, as of late, we've seen a lot of volatility bouncing around that 1 million unit mark with modest improvement. So again, glass half full, we're still moving away, but glass half empty, you'd like to see more discernible progress in terms of housing starts. Now, those are really my glass half full slides. There's also signs of a lot of weakness in housing, particularly starting with prices. Prices have now slowed from a double-digit pace back in 2013 to just under 5%. Now, that's still positive appreciation, but I would argue that prices need to fall further to allow new entrants to come into the marketplace. Remember, average hourly earnings are bouncing around at 2%. So if home prices are continuing to appreciate at a 5% pace, particularly for the youngest Americans coming out of college with $30,000, $40,000 in debt, assuming a 3% savings rate and a starting salary of around $35,000, well, just some dirty math, that means you're living in mom and dad's basement for the next 5 to 10 years before you have that down payment to make that home purchase. And so then moving to the right, you can see first-time home buyers, it makes sense why it's at a 27-year low. First-time homebuyers typically account for about 40 to 50% of the market. They're right around 30% now. Now, part of that is not just an inability to afford a home. Part of that is a change in preferences. If you talk to some of the youngest Americans, they don't necessarily view owning the single-family home as the American dream. They're happy renting for years. They want a non-traditional home, such as a condo, a co-op, a multi-family unit. And what we see, bottom left, is that multi-family construction is now dominating the activity in the housing market. Single-family starts as a percent of starts is the lowest rate since 1974. What we're seeing is rentals and condos coming on the market, not single-family construction. And of course, there's also a move away from buying that single-family home. Trigger points, as we call them, marriage, child rearing, they're happening later in life. And again, that's putting a decline on the home ownership rate, a 2-decade low. So the housing market is still positive, but there's a lot of signs of weakness, reasons to be concerned that housing will no longer be the support of the economy as we move out the next 5-10 years. So what does this mean for top-line growth? Well, as I mentioned, it was a very slow start out of the gate. Just 0.6% in the first quarter, 2.3% in the second quarter, averaging out 1.5%, the weakest rate that we've seen since 2013. Now you're saying, well, that's not too bad, it's only 2015. But remember, we're talking about a scenario where presumably the Fed is gearing up to raise rates sometime soon. So at this point, you would expect momentum to be gaining, not waning in the U.S. economy. Now, going forward in the latter 6 months of the year, we do expect positive growth, as I mentioned, but we are looking for very modest growth, right around 2%. So again, coupled with that 1.5% start in the first 6 months of the year, that leaves us below trend growth, averaging 1.8%, versus 2.1% that we've seen since the end of the recession. So I know that was a lot of information in a short period of time. Let me just run through a summary here. And I want to start with identifying the fact that there are signs of improvement. I don't want anyone to leave here depressed. We are taking steps in the right direction. Remember, recovery is never an easy process. It takes time. It's just taking longer this time. We've seen extraordinary accommodation for the past several years, But the problem is we've only been able to eke out 2% GDP. Remember, on trend, we've been seeing 2.1, and it's likely that this year, 2015, we fall below that trend growth rate. And really, we shouldn't be applauding or patting ourselves on the back for 2% GDP with 0 interest rates. 2% is the bare minimum. We should get 1% from population growth, 1% from productivity gains. So 2% is the bare minimum. At this point, we should be talking about 4, 5, 6% GDP. What was GDP in 2004 before the Fed started tightening? 4%. What was GDP in 1999 before the Fed started tightening? 4%. And by the way, inflation in both cases was 3%. We're now patting ourselves on the back for 2% and 0 inflation? Headline job creation, as I mentioned, remains positive, 58 consecutive months of positive monthly gains. But the pace of hiring remains insufficient to absorb the slack in the labor market and translate into upward pressure on wages. Despite lower gas prices, consumers still remain under pressure, shifting the goods and services in their basket rather than seeing a simultaneous rise across all categories. And remember, healthcare services now accounting for an even larger proportion of discretionary spending. Manufacturing and investment had been the silver linings to the recovery, but amid turmoil overseas, we now see downward pressure on exports and manufacturing as a rising U.S. dollar makes U.S.-made goods relatively unattractive. We also have a heightened inventory. Remember last year, that 2014-style rebound in the second quarter? We saw back-to-back quarters of above-trend GDP, and the Fed said, here we go, here's the recovery. Well, producers listened, and they ramped up activity to take advantage of record low import costs, record low financing costs. Consumption failed to meet that elevated level of production. And now we've seen several consecutive quarters of positive inventory development, which contributes to near-term growth. But eventually we have to eat through that stockpile of goods, and we do expect that to contract from growth in the second half of the year. The global economy, or I should mention again, businesses, as we talked about, despite the fact of who gets in the White House next time around, I do think that these are going to be 3 lingering themes that are going to continue to retard the business development cycle. Again, regulation, taxes, rising healthcare costs. The global economy remains tepid, international demand under pressure as we see some of the largest economies, Europe, China, struggle with declining domestic demand. And as we went through, housing contribution is positive. It's no longer the large net drag that it was during the Great Recession, but it's also no longer the driver of the economy as it once was during the housing run-up years. So again, still positive, but a very limited contribution. So overall, modest growth, like to put this in an equation, what inflation equals the Fed on hold much longer than the market anticipates. And you can see this incredible historical chart of the Fed funds rate, that declining trend now sitting at that historic low of a range of 0 to 0.25, as we have been since 2008. Modest but positive. Looking for an annual growth rate of, as I mentioned, below 2%, 1.8%, keeping downward pressure on rates as it becomes a reality that the Fed will be on hold beyond that September meeting and into next year. And with that, I think we have about a few minutes for some questions, if there are any questions.
We do.
Okay, thank you.
Questions from club members only. Why don't we start in the back of the room and go all the way back to our chairman. Ash, you get the floor.
I'd like to come back to something you touched on right at the end of your remarks, which is productivity. You've seen rather a plateau in productivity. Perhaps you could share with the group a few thoughts on why that might be and what, if anything, might occur that would unwind and unlock some productivity improvements and growth.
That's a very good question, and that is one of the missing components of the recovery is those productivity gains. And we've seen a lot of different answers of why we have not seen that, but no good answers of why we haven't seen that. Part of it is simply businesses are not growing and investing; they're not taking on those new employees. So we're not seeing the investment cycle take hold. Some employers say it's simply because of rising labor costs. When we start to see labor costs outpace the market wage, they're forced to shift away from that more expensive input of employees and move towards more technology. And typically then that cost savings translates into additional hiring and additional development, but instead what we see is businesses taking that cost savings and buying back their own stock, refinancing their own debt, or just simply sitting on that cash. So there's a lot of disconnects that are going on right now in the typical cycle that you would expect to translate into growth and hiring and productivity gains. And I don't know if we could hammer out one particular point of why we're not seeing that, but certainly that is a missing component of the recovery. Yes, sir.
Do you wish to make any comment on Congress's unwillingness to make hard decisions with regard to entitlements and equipment government with regard to the long-term health of our economy?
No. No, I'm just teasing. No, I think actually Chairman Bernanke was very critical of the fact that monetary policy and fiscal policy have been long out of line, and in fact, Fed officials have done everything. Federal Reserve officials have done everything they can to stimulate the economy. And Ben Bernanke was very critical, saying, "Look, we're passing the baton to you guys. You're shooting us in the foot. We need stimulative policies out of Washington, not spending 60% of the budget on entitlements and other programs. We need infrastructure development. We need positive stimulus and not handouts," as I think a lot of criticism came to the $787 billion. It stopped short. It was a one-time cash infusion, but it didn't get the investment cycle going. And so I think one of the problems is the lack of true investment from government spending. And I think another is we haven't even touched on debt payments. Right? Debt servicing payments. Right now, interest rates, the interest rate that the Fed pays is right around 2.4. Well, what happens if interest rates go up 100 basis points? Right now, the annual debt servicing payment is $435 billion. I'm just going to let that sink in for a second. That's more than $1 billion a day. That's 14% of the annual budget. You increase rates 100 basis points, that 14% very quickly goes to 20% of the budget. So now you're talking about the vast majority of the budget already sucked away by debt payments and by entitlement spending. That leaves us very little wiggle room for other further investment from government. And so certainly not a monetary policy standpoint. Chair Yellen has backed away from those, saying it's up to you guys. I hope you do something stimulative. But this is a very broken system that I unfortunately don't think we're going to address until it's even more broken.
Thank you so much. I think everybody was fascinated, including myself.
Thank you.
I had a quick question. I recently heard a speaker kind of suggest that we shouldn't be as concerned about the data on stagnant wages because there's a lot of off-the-book kind of gig income that is not considered in that data. And I was wondering, what your thoughts on that were and how that related to really the true power of our consumers' spending ability.
Well, there's always a part of the market that is the cash market. You can call it the black market, the cash market, the off-the-books market. So we certainly have to take that into account, and we typically say that that's about 10% as a rough figure. Obviously, it's very hard to get accurate figures on the black market. But we do take that into account. We know that that is there. Whether or not that's becoming a growing portion of the economy, we haven't yet factored that into a sizable component enough to say wages aren't rising, but if we take into account that 10% cash market, that suggests that there is enough wage pressure. So it is something to consider. It's another portion of the market is this exchange or barter system that's growing, particularly among the youngest Americans. We were actually discussing that earlier. There's websites now where if you teach yoga and I fix your car, let's exchange services, but there's no income changing hands and certainly no tax ramifications for that. So as the economy continues to evolve, we may have to take that more into consideration. Certainly, the cash market is a very large component of the European economy. And as of late, they changed their GDP calculation to include the black market. Now, don't ask me how they calculate the black market. That's another story. But we may have to adjust if it becomes a growing portion of the marketplace. But as of right now, it's estimated to be a very minimal component.
Sammy?
What effect, if any, will Puerto Rico have as far as a headwind? Or is that just gone away?
Right now, the market's not really focusing on it. They've certainly, the one difference is that they have so many issuers that they're dealing with. And even while they defaulted on one, remember, they issued more debt at the same time. So I think this speaks to the idea that the diversification of debt holders is so much greater than, let's say, compared to Greece. And it's also much more likely that we see a restructuring, we see a haircut, we see adjustments in the interest payments, something that Greece was not willing to do. So it's a very different scenario, and it's more of an economy that needs to grow and expand. It has the capabilities of growing and expanding, rather than Greece, I think, is at a structural point where they need to address monetary policy, I would say, rather than the underlying fundamentals of the economy. So I'm not comparing Puerto Rico as our Greece, as Greece would be to Europe. So it certainly is something to keep in mind, but as of right now, it's fallen to the wayside.
One more question. Good to have you get the microphone.
MBA student at Florida A&M University.
Oh, welcome.
And I know you mentioned earlier the 15% appreciation of the U.S. dollar, as well as the decline that we've seen recently of the Chinese yen. Now, taking an example from the Swiss franc that appreciated earlier this year and saw a major drop in domestic consumership, how do you think the transatlantic free trade agreement that's being pushed through Congress right now will have an effect on us when we're already in such a dire situation?
Well, that comes more down to, I think, a political argument, because you can make the argument that the transatlantic agreement is going to ship jobs overseas, but those in favor of it are going to say, no, it's going to create more jobs for everyone. And certainly, I'm a proponent of free trade. I think the more freedom and flow of capital and individuals that we have is a net positive for the economy. Now, I think the idea that you were alluding to of the yuan depreciating, I almost think it's a misnomer that we say depreciating, because in a sense, they're allowing market fundamentals to set where the yuan is flowing. Now, they're controlling the band on where it can be set on a daily basis. But I think this is speaking to the fact that Chinese officials are not only acknowledging the slowdown in their economy, but they're also acknowledging, hey, if we want to be a major player in the global economy, not only in terms of the transatlantic agreement, but also in terms of gaining reserve currency status, we have to have a more free market. So I would actually say, looking at the decline in retail sales, looking at the decline in manufacturing, as well as the overall decline in growth in China, they had to make that move and allow that peg to be broken. So I think these are positive steps towards a more free-floating currency, and certainly I think any increased relationship with additional trade is a net positive for the economy.
Great. Thank you, Lindsey.
Thank you.
Let me give you this. It's my pleasure. I wanted to present this as a token of our appreciation. This is a limited edition bronze eagle by local and nationally recognized sculpture from here in town, Stanley Proctor.
Thank you so much. It's beautiful.
Thank you again to our speaker. And with that, we stand adjourned, and thank you all for coming today.
You've been listening to a delayed broadcast of the August 19th, 2015 luncheon meeting of the Economic Club of Florida. This program was recorded at the Florida State University Alumni Center in Tallahassee. Join us again next time for another Economic Club of Florida luncheon meeting on WFSU-FM.